Hey, everybody. Welcome to Convo with Duggo. And we got a special guest today with us, and it's Mr. Tim Murphy. And he's going to guide us through a topic that all you agents, I know you're interested in: credit. We're going to really dive into the credit thing so we can help your clients. Matter of fact, it's going to help you. The stuff that Tim told me, I've met Tim a couple of years back, and Tim shared this information with me, and it has actually helped me in my credit personally. So now I got a credit score somewhere in the 800 plus range, all thanks to some of the tips that I got from Tim. So we're going to go through some of that stuff today to help you guys out too. Tim, welcome to the show.
Hey, I'm really excited. I tell you what, it's one of my favorite experiences is getting out there. With COVID, think about it. Our opportunity now, we reach so many more people and we can help so many more people along the process. So credit is one of the best topics of all because really it's the gatekeeper, right?
Yeah.
And for those that don't know me, I've done this now for almost 35 years. I'm an originator. I'm still doing it, but area manager, all that kind of craziness. But also, I do a lot of teaching, a lot of classes. And, I find that the more we can give back to the community, the more we can help people improve the financial situation, the better we're going to be. So home run, man. Great topic.
Absolutely. Absolutely. Tim, you started 35 years ago. Would you start when you were 3? What's going on?
I was actually 4. I was just, prodigy, child prodigy. People are like, he's 4, but what the heck?
Exactly. A 4-year-old talking credit. Awesome. Oh, Tim, look, we got so much. This topic is just so broad and there's so many things we can talk about. And we do have a little bit of a limited time. Let's just dive right in, man. But I figured we kind of start about with talking about just credit in general. What do we need to know about it? What's good, bad? These are all the things we hear. What do we need to know?
When you think about credit, everybody thinks of, Credit Karma. They think about the different levels. And the catch-22 is credit really controls our entire life, whether it's getting life insurance, you know what I mean? Getting your car, credit card. But in the mortgage world, it is central to everything. It's central to pricing. It's central to grants, down payment assistance, different programs, mortgage insurance. There's so many factors involved. And what people don't understand, this is the key, is that they can take control of their scores. Ultimately, so that we get the best payment, least amount of cash, right? And buying power in the process.
Oh, that's awesome. So what would you say good credit? So we get clients all the time that'll come to us and they'll go, I want to buy a house, but my credit's not so good. I'm not really sure. So what is good credit?
So let's call it this way. So we have levels of credit. Fair credit is a 640 credit score in today's business. And credit changes all the time. You can get loans done at lower credit scores, but you're going to get hit substantially on price, rate, points, et cetera, right? So 640 is kind of our minimum now for what I call fair credit. Okay, your average credit we see is about a 680, but good credit is 720. Excellent credit is 760, and then what we call the Doug Owens credit is 100, top of the line score.
Yeah, so if you're hitting a buck and plus over that 760, which is that magic excellent credit number.
It is.
What's the maximum credit you can get?
So scores, it's kind of weird. They run from 300 to 850, like an SAT score, right? So 850 is the top. The highest I've ever seen in my lifetime is an 829. Combination of things, Doug. People don't understand you need 2 credit cards with very minimal balances. You need an installment loan, like a car loan or of installment loan that you're making payments on for a minimum of 24 months. And then ultimately the mortgage, having a mortgage in place for at least 2 years, kind of that combination, that trifecta, right, will get you the high score that you really want to achieve. But you don't need the mortgage to get excellent scores. And that's where people make the mistake.
So what do you need to get an excellent score?
So ultimately, really, so think about your scoring. Your scoring is involved. It's a mathematical model. The reason I love credit scores is, you know what? It is what it is. It's people putting information in, right? And so it's based on past experiences, past credit records, any kind of defaults or challenges. It's based on current utilization, how much you've used of that credit card today, if you will, and then types of loans that you have outstanding.
So you just mentioned a whole lot of stuff there. You only have $500 in this limit. You're brand new. You're just starting out. That's all you got is a limit. So if you borrow that max of $500, what's the impact of that on your credit?
Let's spread it out this way, because that's a great question. So we find that, let's say the limit is $500. When you owe basically 90 to 100% on that credit card, depending on the age and how long you've had it, it's about a negative 30-point hit. So it's like taking 30 points away, right? When you owe 70%, it's about a 20-point hit. When you owe about 50%, it becomes a neutral hit. When you owe 30%, it starts to add points, like you're adding 10 points. And then when you owe 10% or less, which is the magic number, you actually gain about 20 points to your record, which is, to me, is amazing.
So wait a minute. So just for all those people who are just getting credit cards and just getting started, you get a credit card. Nobody's educating you about this stuff. Right. You get a credit card with $500 limit. I'm just going to spend my $500. I'm going to go and buy myself some video games or whatever you're going to spend your money on. And then you think you're establishing credit, but you're trying to tell us if you're in that 90 plus, it actually has a negative impact on your credit score.
Significant. And that's where people make the mistakes, because you're right, Doug. Nobody sits down and teaches you how to use a credit card, how to use a checking account. I mean, think about it. What do they teach you? Here's your credit card. Oh, let's go, right? And I'm using credit and it's good to me. Not so much.
Yeah, not at all. Also I thought was pretty interesting about what you just said. You just said if you're like at 50%, say you have 250 on your credit card, that's kind of neutral. It's not a big bonus for you. It doesn't gain you any credit points. It doesn't cost you any. But once you start to go below that, you get into the 30 and the 20 and 10% of that usage that you actually gain credit points for that.
You do, and it's kind of wild. And now I will tell you, let me kind of put a caveat into here. They don't give us any kind of they don't tell us what the actual mathematical model components are, but experience, it's amazing. Like, I'll give you an example. Now, literally, I had a client, and I'm talking 30 days ago, who had a 619 score. She had one credit card. The credit card was $1,000, and she owed $975 on it. Only had it for about 4 months. Okay. So turned it around. About 5 months rather. Turned it around. I had her pay it down to $10.
Okay.
It came out at the end of January. We waited a couple of days. I pulled it last night. Her score went from a 619 to a 733.
Wow. Over 100 points.
Yeah. 2 reasons. Number one, she only had one debt. So her utilization dropped dramatically. She had 6 months of usage, which is like one of the key principles. So the number, so conservative use of debt, low debt, low utilization, 6-month history. And think about that, 619 to 733, Doug, that blows you away.
So we just said that good credit range that excellent is 720.
Yeah. So she's already in that. And it's funny, she's a single mom, 2 kids. And she said, I can't believe you did this. And I was like, I didn't do it. You did it, right? You followed the guidelines. You can have an almost immediate impact on your credit by just taking some simple steps.
Right. So it sounds like the optimal amount to have is maybe 30% or less. Does that sound fair?
I like 10%. I
like 10%.
10% because here's what happens. You have 30%. Let's go back to that $500 credit limit, right? And you owe $150. That's what 30% is. And then when the state comes out, it's not 150, it's 154 because of $4 of interest. Now you're over 30%, and guess what? You didn't gain that benefit.
At
$50 and you got $4, 54, you're fine. You're still gaining that benefit.
Gotcha. So it accounts for any fluctuation or just slight overages, and it allows you to do that. So keep it closer to 10-ish. So what's the point of having a credit card if I can't spend the money, Tim?
Well, I tell everybody, a credit card is meant to help you build your credit. Yeah. It's not meant to be a spending tool, right? Because let's face it, at the end of the day, I laugh. I tell people credit cards like the work of the devil. What do you do, Doug? You get like 4 credit cards, like $3,000, and then you go to the department store and you buy that new TV, new chair to go with that TV, and then you think, oh, let's get a little mini fridge to have, to keep my beverages cold. All of a sudden, you spent $3,000, and they're like, don't worry, you pay $20 a month, you'll be fine. Yeah, but you paid it off in 23 years at 24% interest rate.
24%. That's a big plus too. Just talking about that.
Yeah. The max is 29.99.
29%?
Yeah. That's
insane.
Nuts. Oh, yeah.
That's crazy. So there's lots of benefits. So keeping a low credit card balance will help your credit card score
dramatically. Yep.
Dramatically. We see that as an increase. Yep. And it also will save you money because you're not paying up to 29% interest.
It is just wild what you can do. And that's, I tell all my clients, I don't care who you are, regardless of where your score is, there's always an opportunity to improve your score. And that's the key, and it affects, like you said, job opportunities. It affects, your credit, your purchasing power, your life insurance, you name it. It has, it's beneficial to everybody.
So, okay. How about this? The person that has no credit, I don't have a credit at all, and I don't even have that $500 credit card. What do I do? How do I get started building some credit?
First of all, I have no vested interest in this company that I'm going to tell you, but I love these folks. It's called Open Sky. And what Open Sky does is it literally is a cash secured credit card. They do not do a credit inquiry on your credit. Now that's important because if you go somewhere and you have 15 inquiries, that's going to hurt your credit. Well, Open Sky will give you a cash secured credit card. You give them $300. They give you a credit card for $300. Okay. Minimally spend that $10. And their program is designed to help people establish credit, or in some cases, reestablish it when they've been through some bumps in the road. And they report immediately. They're on track. They have coaching. It's just a great
coaching.
Yeah. They actually what you need to do, how your credit record is performed, that kind of thing. So yeah, it's wow.
Man, Tim, you're already dropping nuggets for us. I'm going to go ahead and put that in the show notes down below so you can see a link to where we can get to Open Sky. And maybe if you need to get your credit established, maybe this is a good place for you to get started on here. Speaking of starting credit, is there, when a kid graduates high school, they're 18 years old and they're trying to get out on their own, and they do Open Sky, they get their first credit, they're trying to get an apartment, they're trying to get insurance, they're trying to do something that they need some credit, but they don't have any. Is there anything they can do to maybe start out the game a little better?
The secret, Doug, and the secret is as parents, right? What we really should be doing is we should be adding our kids as authorized users on and this is the key, good credit card, right? Don't put them on a bad credit card. Like for me, the particular credit card I have, I placed all of my children as authorized users when they reached the age of 10. Now, that doesn't mean I gave them the credit card, right? but in essence, now my credit record for that credit card was reported on their credit. And so they're 18 and 20, and they've got 700 credit scores because it's reflecting dad's credit card from 10 or 15 years ago that shows up as a record for them. It's a good card. Payment balances are always low. We pay it on time. Everything is solid. So they've got this amazing record. So I gave them that little boost up. I didn't give them the credit card except when they were traveling, or going after, an event, or, that's that safety blanket. You know what I mean? Don't you want to give your kids an extra $1,000 like, hey, just in case you get stuck somewhere? Well, guess what? Just in case you have a credit card and it's got so much in equity, it's God forbid, something happens, you got a place to stay, you've got some access, we've got to communicate. And
it's like walking around with insurance in your pocket, just in case something happens, right?
Yeah. The other thing too that people don't think about, and this is kind of crazy, I like, and don't tell the kids this, right? But when they're traveling, let's say your kid is going to go up to Maine. Tell my kids, use the credit card, for your gas and for your basic stuff, and we'll pay it back later. Well, the reason I'm doing that is because every time they make a transaction, I know where they are. They stopped in New Jersey at this gas station. They stopped in New Hampshire to buy this snack, right? They're staying over here. Doug, I got their history. I know where they went. I know what they did.
Awesome.
Don't tell the kids, right?
Absolutely. I got my kids are out of the room right now because
it's a great tool for you to be able to source it. And God forbid, something happens, you can track them. Where were they last? Where were they today? You can go up into your your statement and look it up and say, oh, Bobby was over here at 9 o'clock. A transaction was made over here, and it's a home run. So
nice
for surety. I like it to build their credit. And quite frankly, I use it as, a security measure, honestly, for myself.
As a parent, we always want to have our kids do better than we do. We want them to be successful in life. What a great way to get their life started off. Imagine starting off your life with a 700 credit score, graduating high school, and all of your friends have 0 credit.
And that's the key right there. And here's the key, Doug, they have an advantage. How many times your kids have an advantage in this marketplace? Well, it's an advantage that costs nothing, 0 cost. And to me, you know what? We all want our kids to have the best of the best, and we don't want them to struggle. And we want them to to have the most advantages they can.
Right. And I guess the only other thing is if you're an irresponsible parent and you can't manage the credit card, it might not be the perfect tool for you.
Don't give them your card. Yes.
Let's not mess them up and give them bad credit. Let's not do that.
I've seen that too.
Absolutely. Now we talk about this. You got a good credit score, and we're in real estate here. My audience is mostly real estate agents and customers as well. So how does this really impact the purchase of the home?
So let's talk about that. So let's kind of, let me take it from a standpoint of a conventional financing, okay? Conventional is Fannie Mae, Freddie Mac. Let's say somebody's putting 5% down, right? Number one, whether or not the system is going to even approve your loan.
Okay.
I hate to say this, you put a 640 in, that's your score. You might not get a loan with a conventional financing, right? That's number one. Number two, it's going to impact the interest rate. More importantly, we find that your PMI, your private mortgage insurance, when you put 5% down, you got great DTI, your private mortgage insurance might be, on 5% down with 800 scores, 0.39. But if you've got 640 scores, it's going to be 1.6. So your payment just went through the roof. I mean, that's a huge jump. Then more importantly, you might need additional reserves or additional money in the bank to show you have something to fall back on with lower credit scores. Also, some programs, unfortunately, won't take certain credit scores, right? So you've got to look at all those aspects. Otherwise, you might need to wait 4 to 6 months.
And Tim's already talked about Fannie and Freddie and what that means to have a regular loan. And so we're actually going to do something in the future. We're not going to dive too deep into that in this episode because this is really all about credit, but we're going to talk a little bit more about what does it mean to have a conventional loan? What does it mean to have a conforming loan? We're going to talk about all of those things coming up in another episode later on. But right now we're going to focus on the credit piece. But just know this. Your credit score does matter to allow you to even qualify. It will save you interest. It will save you on your down payments and also programs and stuff that are out there that Tim's talking about. So it's really, really critical if you want to get into a house.
Hey, Doug, can I throw something in?
Sure.
Everybody says, so give me why are scores so important? Well, if you've got a 620 score, for example, 620 or less, the current factors are that 1 out of every 8 will default on the mortgage. Now imagine, so you got 8 people, right? One's going to go bad out of 8. So why are they so freaked out about credit scores? Okay. Now swing it all the way over and do your 760. It's 1 out of 900. That's why scores are so important, because they're trying to factor in what I call the risk.
Yes.
Risk that you're going to have some challenges down the road. Why are scores so important? Because it's a predictor of how you will pay.
Credit. I love this topic. I'm just really passionate about it because I know the impact that it can have. But what if you came out of the gate and you made some boo-boos? You made a mistake coming out of the gate. All right, you got bad credit. You maxed out your credit cards, or and you're already in a world of hurt. You got a 500-ish credit score. What do you do?
Well, first of all, I always tell my clients, look, the best thing to do, number one, is to get a copy of the report. Now, everybody says, oh, I got my Credit Karma scores. And this, first, you got to understand there are 3 credit score levels. Okay. You got your REIT score, which I call what's the odds that I'm going to make my payments next 12 months. Then you got your installment score, which is like a car score. What's the likelihood I'm going to make my payments for the next 5 to 8 years? And then you got your mortgage score, which is what's the likelihood I'll make my mortgage payment the next 15 to 30 years, right? Well, people don't understand. There's about a 30 to 60 point spread between those 3. That's number one. Number two, more importantly, once you have a basis of where you are, that's an amazing start, because then you know what can be approached. Now, there are things you can do. If it's really bad, we're probably going to guide you and send you to maybe a bankruptcy attorney, because everybody finds out bankruptcy is not that bad. It's Chapter 13 is reorganization. Remember, 13 is not as lucky, right? That's the unlucky number, right? It just means you're going to pay some of it back. It's reorganization. Chapter 7, which is considered a lucky number, it's God's number, right? It's everything is cleaned off. What people don't realize is that in some circumstances, when you file a Chapter 13 and you reorganize and get in a repayment, it's going to do a couple things. It's going to stop the bleeding, stop the interest being charged, stop the fees being charged, stop the penalties from being charged. That's number one. It's going to get you in a repayment group, number two. And then number three, it's going to improve your score. What you don't understand is on a Chapter 13, you can buy in 12 months, as long as payments are on time.
12 months.
FHA, VA, USDA guidelines. If you go with a Chapter 7, most times it's 2 years. Okay, unless there's a house involved. There's a house involved in maybe 3 years, maybe a little longer. But still, having been through a bankruptcy, that's not a bad situation. If it's not that bad, we're probably going to get you into filing disputes, trying to get any kind of errors corrected in place. Sometimes send you to consumer credit counseling, perhaps to work out an agreement on these 2 or 3 minor cards. There are different things you can do. Now you can use a service, and what a service is, it's, and I've got a couple of guys that I work with. These guys are like the mad hatters of credit repair. They know how to write the letter. They know how to approach it. They know what you can dispute. They know what you can't dispute. They know what's an error. They know what's not an error. And at that little magical world, he gets 80% of the stuff removed from people's credit. And the cost is like $600.
Right.
That's bad when you think about when you have $4,000 or $5,000 of collections or outstanding items, and $600 is getting rid of 80%. The man's a magician, if you will.
Wow.
Wow, to use a good service with a good reputation and to be able to have and go through the process and stick to it. Now, everybody says, do I do it online? The answer is no. Because once they do it online, they've basically given up their rights to appeal it a second time. Okay. I like paper. I like letters. I like, registered mail, return receipt requested, because they have to. The credit bureaus have to acknowledge it. They know what the time card starts, the time starts on the process. They got to respond within 30 days of contacting the creditor. It's the way, in my opinion, to appeal it.
Wow. You hear that, guys? So it could be something on there that you can have removed from your credit report just by doing this written letter or using a service that gets it out there. So that's amazing. And by the way, bankruptcy is not the worst thing in the world. I can tell you now, I did not have a Tim Murphy in my life when I was very young. And when I stepped into this thing, I had borrowed a bunch of money on credit cards, ran them up max, did all that stuff. And guess what this guy had to do? File for a bankruptcy. Just to let you know, there is light at the end of the tunnel. Now I'm in the excellent category, as Tim likes to put it. You just said if there was a house involved or something else, it could be like 3 years before you could qualify again.
The reason for it is one of two folds. Number one, if it was a government-backed loan that went into default, you could have what's called a CAVERS claim, and that's the Credit Alert Interaction Verification Response System. That's the government's way of saying, let's put a hold on any kind of new government loans until we get all the accounting worked out. It's a 3-year hold, number one. Sometimes it's a matter of getting the property, even if it was included in a bankruptcy, it doesn't immediately get discharged. They don't immediately remove it out of your name. So it may take time to transfer it out. We want to make sure there's not any outstanding liability. That's number two. And then number three, more importantly, it gives them time, that's the 3-year hold, to really cleanse the system and show that you've reestablished yourself. The mortgage is major. It really is.
But this is really good news, because I actually remember myself when I was in that situation that I was actually nervous about even applying for any credit after that bankruptcy. You feel horrible about it. It does something to you, to your whole self-esteem and everything. So I probably waited 10 years before I applied again, just because I was even too nervous to even ask about it at that point in my life. Had I known, I could have applied and established my credit a lot quicker, right?
Oh yeah. Open sky the next day, right? Come on.
Open sky the next day.
Let's go parachuting. Come on, Doug.
I love it. You file for bankruptcy, the next day go open sky. Don't forget to put that down in the show notes so you guys can have that. All right. So that we already kind of talked a little bit about credit repairs. Or anything else about credit repair? Did we cover all? Did we hit it all?
Yeah, we didn't hit it all. So I want you guys to think about this. You want to use a service that's got a good reputation, number one. I would always ask the lender that you're working with, what service do you have? Do you have an experience? Have you seen the results? I mean, there's some big law firms that are doing a lot of credit repair, and you pay a fee and then you pay a monthly fee, and then 3 years later, you're still paying them a fee. Probably not a good track record, Doug. You know what I mean?
Yeah.
You want somebody that I'm going to pay a fee up front and just get it done.
Right.
Right. I mean, just get it off the books. Now, you can also get a free credit report, remember, once a year. And that's with annualcreditreport.com. So www.annualcreditreport.com. And they will give you a free report, all three bureaus. Now, I tell everybody, do not go and get all three bureaus simultaneously. Remember, there's three credit bureaus, right? Equifax, East Coast, right?
Yep.
Experian, more like Midwest, and then TransUnion, more like West Coast. I tell people, look, start with getting an Equifax report first. It'll tell you what's being said about you.
Mm-hmm.
Then Experian 4 months later. Then get a TransUnion 4 months after that. And then guess what? Your 12 months is up. You can get the Equifax all over again.
Nice.
First, for three reasons. It's not a hard hit on your credit. We need to do these two, number one. Number two, okay, it shows you what's being reported and what's being updated. Now, they're not going to give you scores, but at least they're going to show you what's being corrected. Now, Doug, one of the things you and I talk about this all the time, when you're dealing with a lender, dealing with a service, you want to make sure that wherever you're going, that they're not going to hit your credit multiple times.
Okay.
Inquiries, right? Multiple hits have a significant impact on your credit. We find that every 10 to 12 hits will be a 20 to 30 point hit.
Okay. Wow. So, but that's interesting. So if someone's getting a mortgage and they wanted to shop for a loan and they go to one lender and they go to a second lender, what's the impact on their credit?
It's not within the first 30 days, but it will be impacted after 30 days. I tell you this, look, call the lender you're working with. When they pull your credit, before you ask them to pull your credit, ask them two things. Number one, okay, am I going to get a copy of the report? And the answer is you can ask for it and you can get it. Okay. Because whose credit is it? It's not mine. It's yours. What are they saying about you? How can we fix it? Okay. That's number one. Right. So make sure you get a copy. Now, once you have a copy, you know your scores. Doug, I can shop anywhere. Hey, I got my report. It's a 729 credit score. I want to go FHA, put a 3.5% down. I'm buying a house over Montgomery County. The sale price is $500,000. Can you tell me what my payment's going to be approximately? 30 seconds. That's not a problem, right? You ever bought a car at a dealership? When you do, they always send you to the finance guy next, right? When they send it to the dealership and the financing, the guy pulls the credit. He might send it to 10 different companies to get the best rate and the best rebate kickback to the dealership so they get paid extra bones. Okay, there's nothing wrong with the dealership making money that way as long as it's up front, number one. Right. But I tell people, if you're going to buy a car, get it from your credit union. Get it set up time. Know what your financing is. Or if you tell the guy at the finance, look, I want the special rate you got going on at whatever dealership it is, and I don't want you to pull my credit 16 million times, that's major.
Right.
Because hard hits are hard hits.
Absolutely. It's funny you said that because my most recent car loan I got was through my credit union. I actually went to the dealer myself. I said, hey, go ahead and let me know the rate. And they told me. I just looked at my credit union and said, oh, I'm at least 1.5% cheaper. Hey, Tim, we're talking about credit scores and the government's involvement. The government has dropped the interest rates. I heard there was zero. Why am I not getting zero on my loans?
So the government is basically lending money overnight to the local banks. So that's the overnight rate that the Federal Reserve is lending to the banks themselves. Mm-hmm. So 1 day rate. Well, we're not doing 1 day rates, right? You're doing a 30-year mortgage. So when you're doing a 30-year mortgage, basically in a nutshell, you're doing the 10,950 day rates. That's what 30 years is. I had to do the math real quick. My point is, so if we're lending money for 30 years or almost 11,000 days, we want that you have the ability to repay. And so the interest rate is going to be based on the inherent risk. It's based on the interest rate. It's based on the product. It's based on, is it FHA versus VA versus conventional. It's based on 15 years versus 30 years. By the way, you can go 25, 20, 10-year terms as well. There's a combination thereof.
How can we tell a good lender? You're talking about go to a lender. What separates lenders that if somebody's going to buy a home?
Right. Well, what do you think? It's reputation. I tell people all the time, check to see what the surveys are saying. What's the social survey say? What's their rankings? What's their Zillow rankings? That to me is number one. Number two, I look at the company itself. Now there are three different types of lenders. There's the direct, like the bank lender, right? Then there's a correspondent lender, which is typically will work for a bank, might be an independent, but has multiple sources, but they're still processing and underwriting the closing loan in their names. And you have brokers. Brokers don't have as much restrictions to how they can place it and the flexibility. I want to a lender that's going to offer all of the products, whether it's a housing finance agency like the state of Maryland's Maryland Mortgage Program, you see, all the way through, do they offer an FHA 203K rehab? Do they have any kind of grants, Federal Home Loan Bank grant? What are they providing? Because it's like going to a dealership. If all they do is BMWs, well, all you're going to get is a BMW, right?
Yes.
But you need to see what you can afford. Number one, what special incentives they have. Number two, what kind of terms and restrictions. And honestly, it comes back to, maximum buying power that's not going to make you broke.
Yeah. So all those things, I love it, because now we're talking about getting down to a lender that can really help you. Someone that knows the business, somebody that has a good reputation out there, somebody that can offer you certainly competitive rates, because those things are surely important as well, and somebody that can work and is available to you. There's a lot of banks and organizations out there that it might be difficult to get in touch with them. So if a home comes on the market, you need a lender that's going to be available to help you get that thing done quickly, because the last thing you want to do is has to apply for a loan and your house is on the line, you lose it because it took too long.
Exactly.
Right? You get a hold of them. They call them banker's hours for a reason, I think.
Yeah. Correct. It always kills me when you have a lender like, well, I don't take calls after 5. And I'm thinking to myself, after 5, dude, what, look, I got an offer going on at 7:00 and they're cutting off at 8:00. I got to make this offer now. You know what I mean?
Exactly. No, they're not in my top house.
Yeah.
No way. If I'm going to work with a lender, and I'm actually very much of a stickler with lenders, and it's only certain lenders that I work with, they got to be able to support my clients, because I advocate for my clients when I'm working with them. Any other things that we can think of that maybe like you applied for the loan, you're going through you're in the middle of that process. What's that process going to be like?
So let's talk about 2 things. First of all, if going into apply, if they tell you that you have to pay a big fee up front, run. We call that pirate's mortgage. You know what I'm talking about? It's like, why do I have to pay a fee? Is this a ransom fee before I even apply? No, come on, seriously. You know what I mean? When they're making me pay a fee up front, it worries me a little bit, like, and then most of the times you pay this fee and you don't get it back. And I'm like, it's called a consultation. It should be free up front. You know what I'm talking about? And then to me, you earn your fee, you earn your income when you close. You don't close, you don't get paid, period. So that's always worries the bones out of me, number one. So let's talk about the process. So number one, first and foremost, you're going to call and get pre-qualified. What does that mean? It means I'm going to pull your credit. That's all it is. I get a financial snapshot. I'm going to see where you work, where you live, what you make income-wise, pull the credit, see the scores, and then we're going to establish a timeline. We're going to say, okay, you know what? We've got to work on this, this, and this, because your score is a 595. We want to get to a 640. These are the steps you need to take. Where, hey, listen, your credit looks great. You're at a 685, but you've only been self-employed for 6 months, and FHA requires you to be employed for 1 year in a commissioned position. So we got to wait till the tax year is reported and report the income. Okay. Gotcha. Or, hey, listen, you're self-employed. You didn't exactly report a lot of income last year. Maybe when we file the tax returns this year, we should apply for a little bit more. Or it's a matter of, hey, you know what? I know you don't believe in banks, and I know you have a lot of cash in that can in the backyard, but you're going to have to dig it up, and we're going to have to put some in the bank, because no one believes in secret squirrel money, right? So what are we getting? We're getting that snapshot. We're trying to identify what our holes in the process are, how we can, it's like a chair, 4 little legs, right? How do we prop you up? How do we put you in position in place, set the right line and get you through the process? That's called pre-qualification. Then at that point, you're going to get a letter so your agent can go out and say, hey, Bob Smith is real. Here's Bob. Bob has scores. These guys, his lender says he's approved for a loan of up to X using an FHA loan. Maybe he's getting a grant, whatever the case may be. He's got these little pieces in place and it's in process. That's huge, right? Yeah. So that means that you're legit when you're going out to see a house, and also tells the listing agent whether you're good or not, because let's face it, there's a lot of lenders out there that, right? And they should be running it through some kind of an underwriting system to make sure that it's a good deal. It's a good situation overall. And so I always tell them, did they run it through an automated system underwriting? Can they say for some certainty that the loan's going to get approved? Now,
Right.
most agents, and I always say this, one of the best topics or best things you can do as a tactic is to actually have your lender call the listing agent and say, hey, Marie, hey, it's Tim Murphy with CNF Mortgage. I want to tell you, I'm working with Bob. Bob is phenomenal. He's got great scores. We've got the tax returns, the pay stubs, the W-2s, the driver's license. We even have his blood type. He's A positive, by the way, because that's a tactic in overcoming today's marketplace. Now, what does that tell the listing agent? Let's face it, we're doing two things. When you make an offer as an agent, you're entrusting that lender with your paycheck.
Mm-hmm.
On the bottom line, right? Am I going to get paid, Doug, on this transaction? So I want to know that I can trust the lender and that he's going to sign my check and that I'm going to be paid at settlement. More importantly, can I get it closed on time?
Yes.
Early. How many sellers, Doug, we talked about this earlier, call back and say, hey, is it possible to get the loan closed earlier? And the lender hesitates. That scares the shit out of me. It tells me
exactly.
they have no idea what the hell's going on, or has lost touch with the process, or maybe didn't tell the truth in the initial process and it's going to take longer to get done. Who knows? You know what I mean?
Absolutely. So it's so funny. You hit on all those points. And I think when you're in a real estate transaction, it's really important to have a good team. You have to have a good agent. And we're going to talk about that later on in the channel too, what it takes to look for a good agent. You have to find a good lender. Tim's hitting on a lot of those points now. Bottom line is, what's your trust factor? What is your deal to make sure it's going to close for multiple reasons, not just for yourself. Absolutely. You want to close deals as an agent, but for your clients as well. That's a client that you get into a home or you can help get a home sold. And if you're working with a good lender and you have the confidence that it's going to close because they've done their due diligence, the automated underwriting system is all done, and that they're going to do a good job, and you're really confident that it's going to close. That is, unless they decide to do something crazy at the end of the loan.
Well, they get a car, they get a new truck because I got to move my stuff, or, hey, Doug, I needed a new bed.
Exactly.
I need a king size. It's a king house.
Tim and I laugh at this because we know really it's happened. People are really excited. They're buying a house. They're so excited. They don't have any furniture and it's their first time. And they go out and finance a whole bunch of furniture and they just load the thing up. And next thing you know, their debt to income ratio is too high. Their credit score drops and they cannot afford the home anymore. And they can't even get the home that they just financed all this furniture for.
It looks good in the apartment though.
Yes. All right, Tim. Oh, so that's great. So Tim, this has been great. We covered so much stuff today.
We did.
Any last minute things you got to share for us that we haven't touched on?
No, the bottom line is this, and I think you said right in the very beginning, it's trust and availability. That's what it comes down to. In this marketplace, you got to trust who you're working with. I would ask the questions. In my opinion, as an agent, I would interview your lender. Just like we've done today, how knowledgeable are they? Do they really know their stuff? Number one, do they offer all the products? Number two, number three, do they have a team in place that they're going to accommodate and follow through the process? Number four, the end of the game, are they going to be available? If I have a problem and it's a Thursday night and it's at 10 o'clock in the morning on Friday and somebody's lost their job, that happens. Somebody broke in and broke 3 windows in the house. Can we close with 3 broken windows? How do we overcome issues? You want to know whoever you're working with is available, you can trust, and has a good team in place to make it happen.
Thank you very much for jumping on the Convo with Doug.
Good to see you, brother.
And we appreciate it. Tim,
always.
Have a good one.
Thanks. Bye-bye.
Bye.